Welcome to Skills to Pay the Bills. In today's segment of JustAskFreeman.com. I'm your host, Freeman Owen Jr., and sitting next to me is my lovely wife and co-host, Carolyn Owen. Carolyn, what are we going to share with our viewers today?
Well, Freeman, we're going to talk about retirement preparedness. You know, never before in this country have we had so much information available to us, but so few of us are fully prepared. And that is very concerning. There are many tools and approaches to retirement that are available, but so few have taken advantage of or really understand the simple steps they must undertake. You know, this is a process, it's not magic. Retirement planning can be easy, but it takes presence of mind, having a plan, making adjustments when and if necessary, and with proper coaching, train yourself to stick with it no matter what.
Wow. Carolyn, in other words, you have definitely hit on some major areas we need to clarify for our viewing audience. Viewers, if your young people around, invite them to come and gather around the screen with you, and here's some cool retirement hacks. Now, Carolyn, I want to begin with the fact that there's a new look at old retirement savings guidelines. Saving for retirement is rather complicated, so it's not surprising that a few fundamental guidelines have become popular over the years to help simplify complex ideas. We're going to take 4 of those guidelines. Now, folks, you might have come across it with either reading, researching, or just talking with friends. Like most guidelines, they offer starting points but need to be examined critically and adjusted for your specific situation. Well, let's look at the fact that daily life is full of numbers, and some matter more than others. 4 financial numbers that we're going to focus on could help those who are viewing understand and potentially improve their financial situation. So let's begin with the retirement plan and contribution rate.
Well, you have to think about what percentage of your salary are you contributing to a retirement plan. You know, because making automatic contributions through an employee-sponsored plan could be out of sight and out of mind. And that approach could result in a disparity between what you need to save and what you're actually saving.
You know, now, of course, there's no magic number. The most, I put it this way, the most common guideline is to save anywhere between 10 to 15% of your salary. But what if you start late?
Well, if you start late, you might have to save more.
Exactly. Now, if you save more, if that seems like it's too much, what you should do about that, you know?
Well, you should at least contribute enough to receive the full company match if there is one. And some plans that you sign up for automatic increases each year, which is a simple way to bump up the percentage you're saving over time.
Okay, let me elaborate on that. I heard you say you should match the company match, if any. Well, for one thing, let's look back at, let's say in the 1980s, 89.9% of the companies in the United States offered what we call a pension. Today, only 7.5% of the companies offer a pension. Now, over the last 2 or 3 decades, we were thrust into employer-sponsored retirement accounts, like the TSP, the 401k, the 403b for educators. These employer-sponsored retirement accounts early on offered a match. There was a match for every contribution you made. Now today, most of these employer-sponsored retirement accounts, there is no match. And what you say, the plans let you sign up for automatic increases each year, but there is no more free, what we call free money. And it is a simple way to bump up. Now, let's look at the second of the 4 financial numbers that we know.
That's your credit score.
Exactly. When you apply for credit, big ticket items such as mortgages, automobiles, car loans, credit cards, your credit score is likely to factor into the approval decision and affect the terms and the interest rate you pay. So why don't you share with the audience, what is the most common credit score?
Now, the most common credit score is the FICO score.
Exactly.
And that's a 3-digit number that ranges between 300 to 850. Now, at one time, you had to pay your check pay to check your score. But many credit cards now offer this service free.
Exactly.
So-
Like you have Experian, Equifax, and TransUnion. You can get your free credit report once a year from annualcreditreport.com. That can happen every 12 months. But I recommend that we look at our credit score at least once a month, because you could get hard counts, that is, queries on your account, which would, on your credit report, and the reporting to these credit agencies, is there's a possibility that your credit score could decrease. So or some authorized hit on your credit report or credit score. So it could possibly decrease. So it's good to examine that credit report. And there's a small fee with some of these agencies with the 3 credit reporting agencies. But it's a good during these times to consistently monitor your credit report and make any changes on that credit report and that is erroneous, and take care of that, because it does impact you when you apply for a mortgage, like we said, automobiles, credit cards, etc.
Now you can get a free credit copy every 12 months just by going to annualcreditreport.com.
Exactly. Now, here's a number, Carolyn. Let's talk about debt to income ratio.
Okay.
Now, I'll refer to that as DTI henceforth. Your debt to income ratio is another number in which lenders decide whether to offer you credit. All right. What if a DTI is too high?
Well, it may mean that you're overextended.
Exactly. Your DTI, folks, is calculated by simply adding up your major monthly expenses and then dividing it by your gross monthly income. And the result then is expressed as an opinion, as a percentage. So if your monthly, here's a good example, if your monthly expenses is $2,000 a month and your gross monthly income is $6,000 per month, well, what is your DTI score?
Your DTI score is 33% then.
Exactly. Now, lenders decide what DTIs are acceptable, already, based on the type of credit. But let me add this. If you have credit cards, it is best to keep the balances under 33%. Why? Because lenders see that you are credit worthy, all right, and you control your debt. And anytime that you have your credit scores, that DTI is a third or less, you can improve your FICO scores. That's right. So lenders decide, as I said, DTI is acceptable based on the type of credit. But, for example, a ratio of 43% or less is standard for many types of mortgages. But the percentage might be more or less depending on the specific situation of our viewers.
But the good thing is that once you know your DTI, you can take steps to reduce it if necessary.
Exactly. You may be able to pay off low balance loans to remove it from the calculation, or taking on new debt, which might negatively affect your DTI. You should check with your lender first if you have questions about acceptable DTIs. Now, fourth number, net worth.
Yes.
All right. Your net worth provides a snapshot of where you are financially. To calculate your net worth, you just simply add up your assets, what you own, subtract out your liabilities, what you owe. And so ideally, your net worth will grow over time as you save more and pay down debt, especially during retirement or as you approach retirement. So what if your net worth is stagnant or even declining?
Well, if your net worth is stagnant or declining, then you might take time to make some adjustments to target your financial goals, such as trimming expenses or rethinking your strategy,
Exactly.
your investment strategy.
That's right. So folks, your 4 financial numbers is crucial to your retirement plan. You may have multiple 403Bs or multiple 401Ks, from different employers. We can consolidate them and just look at your overall retirement plan. You can get your free retirement kit now, all right, at justaskfreeman.com.
Okay.
Now, this is critical. Growing retirement assets, okay? And I think our viewing audience should know deferring taxes to accelerate growth of their retirement programs, okay?
Now, how do tax-deferred compounding work to your advantage?
Well, with the conclusion of the tax season, many Americans reflect on how much more they pay in taxes each year. It quickly becomes clear how taxes are paid on capital gains, your dividends, interest. That can quickly erode your portfolio.
Now, what if you had a chance to increase the return potential of your money without adding to risk? Would you take it?
You bet I would. I'd be right on that. That's precisely what can happen in accounts that can defer taxes until assets are drawn. Now, I'm going to quote Albert Einstein. He said, compound interest is the 8th wonder of the world. He also said, he who understands it earns it, unquote. Now, we know that taxes cannot be eliminated from a tax-deferred account. However, they can be controlled. So that's where tax deferral falls into place. Mm-hmm.
And what is tax deferral?
Well, tax deferral, what that does, it with your interest, dividends, or capital gains that accumulate, basically tax-free until you take a distribution from the vehicle that you have and withdraw the amounts. The most common tax-deferred products include individual retirement accounts and annuities, rather common. Even your employer-sponsored retirement accounts, they're tax-deferred too, as well. Now, the next question is, how does it benefit various participants in these tax-deferred programs?
Well, by deferring taxes on the returns of an asset, the participant benefits in 2 ways.
Oh, let me answer that. I got the answer to that.
All right.
Either tax-free growth, growth, and good demographic timing.
Okay.
Well, let's look at tax-free growth. Instead of paying taxes on that asset, I see that we're going to have to take a break here. We'll be right back.
Minds can achieve anything. We make sure they get to college. Federal student aid provides more than $150 billion in grants, loans, and work-study funds to make college possible for anyone with the mind to get there. Because if given the chance, minds will do great things. Federal Student Aid, proud sponsor of the American Mind. Learn more about money for college at studentaid.gov.
Well, thank you for joining us on Skills to Pay the Bills in today's segment of JustAskFreeman.com. Today we shared some very important information on being prepared for your retirement. In that last segment, Carolyn, we were talking about tax deferral. We got to review that a little bit here because a lot of folks don't really understand what tax deferral is all about. It's where they don't know the equivalency of what is tax versus tax deferral. And when you receive interest on your vehicle, such as interest and dividends and capital gains, it can make a difference in the accumulation amount. We're going to talk about that later on in this segment. Okay. But first, let me kind of rehash how does it benefit the participants, tax deferral. I was talking about tax-free growth and good demographic timing. Instead of paying taxes on the return on an asset, excuse me, it's paid only at a later date, leaving that asset time to grow unhindered. Okay. Now, good demographic timing, most retirement contributions are made while the individual earns income at a higher tax rate. Now, I call that the accumulation stage. When we're in our working years, we accumulate assets, we accumulate wealth. As we approach retirement, let's say we start looking at age 50, 55, we start thinking about distribution and having resources such that we have income that lasts us a lifetime. Well, simply because life expectancy has increased significantly. So individuals receive income in retirement are earning substantially less income, and they may be taxed at a lower rate. So tax deferral works well. Now, for future retirement expenses, the longer taxes are deferred, the better. Okay. Let me give you an example. Folks, let's say we have $100,000. We get 4% interest, and you're in the 25% tax bracket. Now, over a 20-year period, that's approximately $180,611 over 20 years. But in contrast, a $100,000 tax deferred contribution earning 4%, 25% tax bracket would grow, or would have grown over 20 years, $219,112. Now that's $38,501 advantage right there. Excuse me.
Okay. So now, how do you combine tax deferral with the guaranteed income payment?
Well, tax deferred annuities can be fairly straightforward. You pay an insurance company to insure the income in the future. These tax deferred annuities have become very, very flexible and diverse over the years, starting back in 1995, for example. The insurance company, or I should say the insurance industry, introduced what we call FIAs, or fixed indexed annuities. They pay interest, but it's based on the performance of a market index such as the S&P 500.
Yes, while an FIA is usually subject to income tax paid when withdrawals are made, participants can have the benefit of tax deferral to earn interest on their principal, on their credited interest, and savings from the tax deferral.
Exactly. Now, we're going to share the allocation of the assets through various buckets, growing tax deferred. Now, FIAs offer a variety of options for earning interest too, where the person who's contributing to, say, an annuity, fixed index annuity, can adjust their objectives or circumstances if they change. They can adjust these, I'll call them, we'll look at them as buckets, all right, that represent different vehicles for the money. First, we'll look at the fixed account. Now, that fixed account might be, pays a guaranteed rate for a specified period of time. Okay, and the amounts allocated to this option would be credited with an interest rate that is current on the date the solution is effective. All right. That's a pretty good choice. Right now, the interest rates on the fixed side of that is pretty low. But you want to know at the beginning of you will know at the beginning of the year how much interest is credited at the end of the year.
Oh.
Now, another bucket we'll look at, Carolyn, domestic equities. If you want to participate in the performance of a broad U.S. market, another bucket would be linked to what we call the S&P 500 or Barclays or any other. But remember this. Now, this S&P 500 is widely regarded as a premier benchmark for the domestic stock market. But the fixed, let me define this, the fixed index annuity, your assets are not in the market. There's a guarantee of the principal and interest that has been earned in the past, or the previous, let's say, term, year, because it's usually annual crediting. So again, when I talked about domestic equities, these are strategies that are applied to that fixed indexed annuity. You have the link to market indices, but your assets are not in the market, okay? Investors who want, or I should say those who wish to purchase fixed index annuities who want an international equity exposure, well, you could have allocated across a broad array of global equity markets, selected sectors. Again, these are strategies that are applied to the FIA where the principal is protected. And I'll say that with the fixed index annuities, these insurance companies have them. Now, the insurance company themselves is based on their financial strength and the claims paying ability of that insurance company where they have these fixed index annuities, all right? Okay. One other bucket I want to just briefly talk about is the risk manage momentum. Now, that's a mouthful. Mm-hmm. Okay. This is where, viewers, you want exposure to an even wider variety of asset classes beyond equities. Of course, there are other strategies that are available. Now, I'm going to say this. Multi-asset strategies allocated across equities, gold, interest rates, and cash in an effort to outperform fixed weight portfolios. And so therefore allocating more to assets that show more of an upward momentum. Now, the volatility control mechanism is used to manage downside risk. All right? Okay. So in fixed index annuities, you get all the upside, but no downside, okay?
And then there's flexible tax deferred choices that grow your savings. So what advantages are there to the indexed account?
Now, let me add this. If an index turns negative
okay.
during a term, all righty, the account cannot be credited below zero. That's why I said that the asset, the principal is guaranteed. On the other hand, when you have a positive index performance, the account has the potential to receive credit increases. And since an index account can never have a negative interest rate, the account can experience positive growth when an index rebound. So again, you get all the ups and no downs, all right? So regarding income payouts, please keep in mind that the annuity guarantees are subject to the claims paying ability of the issuing company and its financial strength. So if you want to know more, get my free retirement kit, and you go to justaskfreeman.com. You know, Carolyn, for the retirement dimensions in life, growth today for income tomorrow, that is key.
Yes, because if you're like many individuals nearing retirement, you're looking to achieve two primary goals: accumulate dollars today and receive dependable income tomorrow.
Exactly. The journey between those goals, let me tell you, there may be unwanted risk exposure unless you have adequate information. Knowledge is power when it's executed. You need good, solid counsel, access to proven strategies, and folks, we have strategies that you, the viewer, may want to consider to secure a sustainable retirement lifestyle. It's proven. It's the cornerstone of financial product. As of 1995, it is the fixed index annuity, or FIA. All right. So in effect, it's a contract between you and the insurance company designed to help meet the long-term retirement needs in exchange for your payment of an insurance premium. The insurance company gives you the opportunity to earn additional index based on the performance of that market index and pays you an income in the future. Okay. So what we could do is ask our audience, is a fixed indexed annuity right for you? You might be a good candidate for an FIA if you agree with any of these statements. We've heard these statements. You know, these folks come into the office and we're sitting down there, we're reviewing for them. And they say, well, Mr. Owen, I want to receive, or I want a convenient way to receive predictable monthly payments after I retire. Well, a fixed index annuity can provide that. A lifetime income that you cannot possibly outlive. Well, another statement, I need to find a way to preserve my retirement principal. As I said during this segment here, is that the fixed index annuity, that asset the principal is protected and guaranteed by the claims paying ability and the financial strength of the insurance company that issues that product for you. All right. I've heard I'm retiring yet, still my money needs to keep growing while it pays me an income. Well, that happens with an FIA. You take a distribution, the balance can continue to grow. All right. And I like a solution that locks value in I can leave to my heirs. Legacy is so important, folks. You designate your beneficiaries for your spouse and your loved ones, kids, grandchildren. We have tons of information, even information about the inherited IRA, whereas we have generations of your legacy going to your children, grandchildren, even your great-grandchildren. All right. Thank you, Carolyn. Appreciate you being here.
It was a pleasure.
All righty. Thank you so much. And as we're out of town, of course, out of time, but before we leave, I want to remind our viewers to email us at freeman@justaskfreeman.com to get a copy of your free retirement kit. Even you can get a free Social Security report with the various maximization strategies. So I want to thank you for watching Skills to Pay the Bills in today's segment of JustAskFreeman.com. Carolyn and I will join you again next week for another great segment. But have a fantastic week, and have a fantastic week on purpose.